At 9:43 a.m. in Beijing, a silent tremor rippled through global markets. Nearly $19 billion in U.S. Treasuries disappeared from China's portfolio in a single, unannounced move. Within minutes, Bloomberg terminals across Washington began flashing alerts. By noon, data confirmed what insiders had whispered for months. China's holdings of American debt had collapsed below $765 billion, their lowest point in over a decade. No press briefings, no leaks, just numbers that spoke for themselves. And the timing was almost theatrical. Barely 12 hours earlier, Donald Trump had stood before cameras threatening a 50% tariff on BRICS nations, mocking their alliance as a fading joke. But that so-called joke had just executed $855 billion in trade with China, and not a single US dollar was used. No Western banks, no SWIFT networks, just settlements in local currencies, yuan, rupees, rubles. Transactions moved through systems Washington doesn't control. It was a quiet revolution, the kind that doesn't need a headline to change the balance of power. According to China's customs data, trade with BRICS members grew nearly 4% year over year, at a time when global trade was supposedly shrinking. That single figure raised a question the US wasn't ready to answer. If the dollar was still untouchable, why was Beijing unloading US debt and hoarding gold instead? The truth was uncomfortable. Treasuries no longer looked safe. Moody's had just downgraded America's last hope-away credit rating, sending yields on 10-year notes past 4.5% and on 30-year bonds near 5%. But higher yields no longer meant confidence. They signaled distress. Investors saw a government paying developing nation rates just to fund itself. Japan noticed. Once Washington's biggest creditor, holding $1.3 trillion in U.S. debt, Tokyo had started trimming its exposure quietly. And yet, strangely, Britain's holdings surged, overtaking China's for the first time ever. Analysts at the Financial Times soon uncovered the illusion. Much of the British buying was actually custodial. Intermediaries disguising the true source of funds. Someone was filling the gap China left behind. That someone turned out to be America's own allies. G7 nations, Europe, Japan, Canada, were quietly absorbing the debt others no longer wanted. They weren't doing it out of optimism. They were doing it to keep the system from cracking. They were propping up a financial architecture that punished them with inflation while Washington lectured them in public. In a fiery G7 press conference, Trump reminded Europe it owed America for 75 years of defense, then issued a blunt threat: match Japan's cooperation, or face a 15% baseline tariff. Hours later, Japan revealed what cooperation really meant: a $550 billion investment fund dedicated to rebuilding American industry. Not trade, not aid, control. Semiconductor plants, mineral hubs, and pharma facilities would rise on U.S. soil, financed entirely by Tokyo. What began as an argument over tariffs had evolved into a system of economic pressure, diplomacy replaced by debt dependency. Europe folded next. The EU accepted a reduced 15% tariff rate, down from 27.5% on cars. Hidden deep in the agreement's fine print, though, was a clause promising innovative financing mechanisms, polite language for more money flowing back to the U.S. The irony was bitter. By buying U.S. bonds, these same allies were funding a government that was turning them into economic hostages. Treasury data showed roughly 30% of all U.S. debt sat in foreign hands. What was once a symbol of American strength had become a trap. Selling would trigger global panic. Holding meant absorbing the losses. It was a lose-lose scenario, and China was the only one stepping out of it. For generations, America's true weapon wasn't its military. It was its balance sheet. The dollar's credibility built an empire no army could match. But that foundation is cracking. Allies now finance Washington's deficits while being threatened with tariffs. Adversaries buy gold instead of bonds. And the president treats international trade like an auction. Pay up or get punished. China, meanwhile, is moving deliberately. The People's Bank of China has purchased gold for 18 straight months, the longest buying streak in its history. Chinese mining firms are expanding across borders, acquiring assets from Central Asia to Africa, including a Kazakh mine expected to produce 5 tons of gold each year. In Hong Kong, gold company IPOs are booming, raising billions in fresh capital. This isn't diversification. It's an exit strategy from the dollar's gravitational pull. At the latest Shanghai Cooperation Summit in Shenzhen, Beijing unveiled its next move: a digital trade network linking Eurasian economies, completely independent of the U.S. financial system. No dollars, no Western banks, no intermediaries. If the platform succeeds, it won't compete with SWIFT. It will replace it. Washington's answer has been pressure. Commerce Secretary Howard Lutnick now speaks openly about demanding Japan-style investment pledges from other allies. South Korea, facing a 25% tariff threat on car exports, is already considering a $400 billion US investment fund just to stay in Washington's good graces. What's emerging isn't trade, it's tribute. A new global order is forming, not through war but through quiet financial rebellion. And each treasury bond China sells is another step away from a system that once seemed unbreakable. The message from Washington was blunt. According to sources in Europe who spoke privately to Bloomberg, Trump's negotiators warned that unless America's allies bought into upcoming infrastructure projects, they'd face a 30% import tax. The idea wasn't up for debate, it was a demand. Treasury Secretary Scott Bessent later defended the strategy, arguing that with interest rates near 5%, the United States could no longer afford to fund its ambitions alone. If partners wanted access to lower borrowing costs, he said, they should invest directly. What Washington framed as innovation looked to many more like arm twisting. The irony couldn't be sharper. Years ago, the US accused China's Belt and Road of ensnaring countries in debt-trap diplomacy. Now America was effectively doing the same thing, but to its friends. At the same time, something larger was taking shape beyond the Western lens. Trade between China and the expanding BRICS network has quietly surged to nearly a third of Beijing's total foreign commerce. And it's not cheap goods driving that boom, but the high-end machinery, chemicals, and production equipment that power entire industries. This isn't a club of struggling nations anymore. It's an industrial coalition forming without Western permission. Trump, however, dismissed the threat. At a Washington summit, he boasted that BRICS had tried to challenge the dollar. "We hit them with 10% tariffs," he laughed, and their next meeting was half empty. But Treasury data tells another story. China's settlements with BRICS nations, worth hundreds of billions, didn't fall. They climbed. The president might have won the headline, but the numbers told a quieter truth. America's manufacturing heart was fading. Factory employment has been contracting for months. The ISM index sits below 50, signaling decline. Over 80,000 industrial jobs have disappeared since January. And while the administration celebrates the return of factories, the raw materials feeding them, copper, aluminum, rare earths, are imported and now far more expensive under new tariffs. That cost trickles down. Higher tariffs mean higher prices, weaker demand, and fewer jobs. The government wants to rebuild industry, but inflation is making that dream heavier with every shipment that lands at US ports. Unlike in 2018, the Federal Reserve no longer has room to maneuver. Cutting rates would sink the dollar. Raising them further could wreck the bond market. So Washington has turned to another tool, other people's money. Japan's $500 billion investment deal was just the opening act. Quiet talks are underway with Canada and the European Union for similar financing packages. But those allies are already hurting. Canada's housing market is collapsing under debt. Europe, deprived of cheap Russian gas, is fighting an industrial slowdown. Germany has slipped into technical recession. France is battling double-digit inflation on energy. These aren't wealthy patrons. They're wounded economies being pressured to fund America's recovery. If they refuse, the next step is escalation. A 50% tariff on BRICS goods is already being discussed in Washington, while Brussels is preparing a 30% retaliation list worth $17 billion in US exports. Should both sides pull the trigger, it would ignite the most severe trade rupture between Western powers in modern history. More damaging than the Airbus-Boeing disputes, more hostile than the old steel wars, because this time the fight is about control of investment, not trade itself. At the center of all this turmoil lies the US Treasury market, the quiet core of global finance. Despite China reducing its exposure, foreign holdings of US debt hit a record $9 trillion this spring. Which raises a chilling question: who's still buying and what happens if they stop? If central banks across the G7 begin to scale back support, America would face three impossible choices: print more dollars, default, or plead for capital. None are politically survivable. Yet all are becoming increasingly real. That's why the next round of US-China talks in Stockholm matters so much. Officially, the agenda is about agriculture, cybersecurity, and energy. But behind closed doors, Washington's true request is simple: stop selling treasuries. Keep the system stable. Beijing shows no interest. From China's view, the logic is obvious. Buying US debt funds your rival's trade war. Buying gold shields you from it. Building trade routes beyond the dollar makes those wars irrelevant. It's a quiet revolution unfolding in plain sight. As the West battles inflation, weak growth, and populist economics, the foundations of global power are shifting. The new order isn't arriving with gunfire or headlines. It's appearing through trade balances, capital flows, and one subtle sell order at a time. The financial war isn't coming. It's already here. And perhaps the greatest irony of all is this. The United States, once the architect of the world's rule-based economy, is now testing what happens when the rules no longer work in its favor. But rewriting the system doesn't restore dominance. It only reveals how much of it has already slipped away.